Actually, it kind of segues neatly into this next discussion because 2024 has seen a total of 57 sort of completed IPOs so far. The number is similar numerically to 2023, but the same 57 IPOs have raised more money in the first 8.5 months of this year as compared to the whole of last year. Debasish Purohit is co-head in India Investment Banking, Bank of America, who is joining us now. Debasish, it's great to have you with us here. Good morning. Just a quick word on, it's getting bigger and bigger, isn't it? I mean, I think natural to expect it. The size of what's coming to the market is getting bigger, and I think the pipeline ahead is much bigger. Some of the bigger ones are all coming to the market soon. I mean, NTPC Green, there is Hyundai, and there are so many others. So just wanted a quick sense from you, what's lined up ahead of us and what it bodes for the secondary market. Go on. Debasish, you'll have to unmute yourself, please.
Yeah, can you hear me now?
Yes, please. Go on.
Okay, yeah. No, I think you're right. I think this is consistent with the trend that we had picked up probably at the beginning of the year. And I think in a couple of other media interviews, I'd maintained that what we'll see in terms of capital raising and IPOs in 2024 is going to be a trailer for the subsequent 12 to 18 months. And we expected the second half of the year to rush in some of the larger IPOs. The first half, you had a volume of IPOs, but the sizes were pretty small. Just to put the data in context, we've had only 4 IPOs so far this year of sizes in excess of $500 million, and 3 out of those got priced in the last 4 weeks. So this is a sign of things to come as we go towards the end of the year, and as we turn the leaf into 2025. The IPO size is going to be bigger. In fact, I think 2025 potentially would be the biggest ever IPO year that we have seen in our lifetime.
Debasish, do you have a visibility on how many $500 million plus issues are lined up over the next whatever time frame you want to look at? And when you look at 25, you clearly have, because the pipeline is there and you can see it. What are we talking about? What numbers are we talking about?
Yeah, again, it's difficult to give a sense of the exact quantum of the number of IPOs. But if we were to aggregate everything together, a sense is probably over the next 12 to 18 months, we'll see an IPO pipeline of maybe $25 billion plus.
Right. Debasish, quantitatively, while the numbers are large and the numbers of companies which are coming to the markets are large as well, we haven't really seen a frenzy when it comes to valuations. At least in a lot of the companies which are being offered right now, at least they're leaving some money on the table, and thereafter, post-listing, we're seeing a bit of a frenzy in these stocks. Do you think investors have become smarter and they demand better valuations from companies which are coming to IPO, or what phase of this frenzy are we in right now?
Yeah, I think that comes back to the way the IPO market is constructed versus to the listed traded comparable in the secondary market. I think IPOs is still a lot of hard work in terms of putting out your equity story with investors out there. And bulk of these activities are front-ended with institutional investors, right? With both foreign as well as domestic, who do their grounds of fundamental work on the equity story and then stamp out a valuation which they're comfortable with it. Whereas you take it to the secondary market post-listing, I think then the world kind of takes over with all this retail and high net worth participation, which takes it to a different level. So there's a bit of a dichotomy between the way you see the so-called frenzy in the secondary market and the way IPO pricing are constructed, which is why you see I think the pricing of the IPO is much more fundamental driven, largely led by institutional investors, and then kind of the secondary market takes over, which is a result of the unprecedented liquidity flow that we're in the middle of.
Debasish, hi, morning. So that's on the primary market side, but the secondary market itself has been so hectic, right? Investment bankers probably have had such a busy year. So many secondary sales where either promoters are selling a part of their equity or early stage investors are cashing out, PEs are checking out. Do you expect this activity to remain as hectic, as heightened as what we've seen so far in this calendar year? And also, what are the triggers at play? I mean, earlier when we asked this question to a lot of people in the market, I think the response is that PEs have their own compulsions. They need to go out and, pay out their investors. But what's your sense? Is this the result of a huge amount of domestic liquidity? Will it continue to be as elevated?
No, I think there are 2 or 3 reasons, right? One is that if you look at the construct of or the capital of the new IPO going companies, they are dramatically different than the variety that you saw, let's say, 5 to 10 years back, right? So the most of the, at least the newer age companies coming to the IPO market have much more diversified capital in terms of, multitude of investors who need an exit over a certain time frame even after listing, which means there's much more supply to come even in the aftermarket, which has been the case with, I think, most IPOs which has come to the market last 2 to 3 years. So that is reason number 1. Reason number 2, I think the liquidity profile of India market has transformed materially over the last 3 to 4 years, giving confidence to both pre-IPO investors as well as private equities and sponsors to monetize effectively without creating any market disturbance of the stock price. So that is reason number 2. The liquidity profile is making people confident. And third is obviously, I think we have seen a wave of investments from the PEs, which is kind of maturing to an extent. I think people are looking at exiting some of those old positions before they rebuild their new positions. So I think these 3 factors together will continue to make the secondary block market reactive.
Debasish, to get back up, and this is obviously on the primary market, and we've had another blockbuster listing just as we speak. But my question, going back to that question, that was more for the secondary market. Forget the primary market for a second. Even in the listed space, there is so much hectic deal activity, right? Where promoters are either cashing out a little bit or PE guys are checking out. So more on the listed market space, will deal activity continue to be as robust as what we've seen so far?
Absolutely. This is exactly what I was saying. I think we do see that level of activity even in the secondary market to continue. And that is driven by the shifting nature of the cap table, right? Because 10 years back, you had a largely promoter-owned entities coming to the IPO, and the maximum float which will come to the market is the bare minimum, which is 25%. Now the new generation of companies coming to the IPO market are much more diversified in terms of pre-IPO cap table. You have multiple investors sitting over there who have a certain investment horizon, so they need to exit their positions over a certain period of time. So the free float, the effective free float which is coming to the market is significantly larger than the IPO class of, call it 2010 or 2012 or 15. So we will continue to see a significant amount of activity in the secondary market on a go-forward basis.
Cool. So just to take the point forward, how much of this activity that you're seeing, again, primary market, right, is in your estimation growth capital, and how much is it sort of exit by investors? So this year we've seen about 64,000 crores worth of IPO. Have you looked at the numbers? How much of it is going into building out businesses, setting up plants? How much is it just sort of existing investors getting out? And that $25 billion number which you put out over the next 12 to 18 months, I mean, same question. What would it be?
Yeah, I think if you go back in history, I think Indian IPO market have been largely secondary driven, right? I think the ratio could be anywhere between, call it 70 to 80 to 90% of IPOs coming to the market are secondary sale rather than primary sale. And even if you look at the next batch of large IPOs over the next 12 to 18 months, a large part of these would be secondary sale rather than primary proceeds. That's not going to change in my view. Okay,
you're saying that 70-80%, that high, I mean, essentially, is all secondary sales. And perhaps it will be in that ratio going forward as well. Got it.
That's right.
Just one last question. What are the hot sectors right now where you're seeing, where we should expect to see maximum deal activity going forward, Debasish?
I think it's pretty much everything, right? I don't think there is one particular sector.
There are no cold sectors. They're all hot.
Yeah. Well, you have the all-time favorites like consumer, financials. The technology is coming back in a big way, as we saw through Ola and first try listing, and the significant pipeline which is building up. Healthcare is pretty topical. I think the one sector which has stayed away or rather absent from the capital markets, which is infrastructure and renewable, that's because the deal activity in the private space is so robust. They haven't probably found the reason to come to the public market. And hopefully we see that change over the next 12 to 18 months. But save that, I think pretty much every other sector is in play.
new economy, people are saying because it's new economy, growth prospects, sunrise sector, etc., doing extremely well. Old economy doing even better because they're saying it's not sunset yet for this sector because not anyone else is investing in these spaces right now. So maybe there is a longer runway than one was expecting. And middle of the road, obviously doing extremely well anyway.
So, to end things, Debasish, I'll go back to Mangalam's original question on valuation. So as all these hot sectors keep coming to the market, have the lessons been learned, and will it be very different from, say, 2021? I mean, we all remember the way Zomato IPO'd and a lot of the new age companies came in. So as we get the Swiggies of the world and maybe some of these newer businesses, even renewables, which right now you're saying is within the private domain, as and when they come to the street, what should investors expect on valuations?
And just to add to that, what could the next accident be? Because back in the day, we've learned lessons from those accidents. Now we've moved on. What should one be mindful of?
Again, it's like, markets turn in a cycle, right? I think we saw a pretty long bull run, then we saw, some bit of a pause in 2022, and then the markets have come back in a pretty big way. It's very difficult to predict, what could be waiting for you in the next turn. Of course, I think valuations are extremely important to sustain this market. But I think what makes us comfortable and confident is that the exuberance that you see in terms of valuation in the secondary market has not translated compared to the IPO market. The IPO market is still very, very fundamental driven, bottoms of institutional investors driven, which is why you're seeing this divergence of what you get at the IPO at valuation versus what some of the stocks are trading in the aftermarket. I think so long as that discipline continues, that's good for the primary market, and this market is here to stay. It's difficult to say what's the next accident. I think we as market participants we are optimistic. And we look forward to the positive signs rather than worry about the potential accidents around the corner.
No one sees it coming ever. It happens when it happens, but it's going. The going is good. Thank you very much, Debasish. Appreciate you joining in and running us through your perspective on the sort of fundraise activity, which is robust, as Debasish has been pointing out.